Okay, let's see now.
My is back, so I'm not sure what's going on this morning. It seems to me that the go to webinar is a bit cranky as well. Okay, so but nevertheless, let's get kickstarted again. So I think all is good now. So basically over here is let's have a look at the disclaimer slides first. Okay, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, all good. So now, before we jump straight into the short-term technical outlook, i.e. the intraday short-term technical outlook for the broad-based cross asset classes, let's have an interesting recap of what has taken shape yesterday. Indeed, a very interesting price movement in terms of the news flow and the key economic data releases. So yesterday, there are actually two key economic data releases. The US CPI data, then followed by the FOMC. So let us take things one step at a time first to digest the news and the fundamentals before we jump straight into the technicals. All right. So with that, let me share with you all my screen again over here. Okay. So let me open up the calendar. Okay. So let's take a look at the US CPI data first. All right. So the US CPI data actually the core inflation rate, which is excluding energy and food, actually came down within more than expected. So market is expecting a slowdown to 3.5%, but it actually came down to 3.4%. So that's actually, technically speaking, from a fundamental perspective, it should be an encouraging sign for the US Federal Reserve to start thinking about interest rate cut cycle, not hike cycle. All right, so if you look at the trend, the 5-year trend, all right, it's been deceleration, the core CPI rate to 3.4%. So this level here, in fact, is the lowest level since April 2021. All right, so that should be an encouraging sign for the Fed in the eyes, because in the last few FOMC meeting and a slew of we call it Fed speak, they have been concerned about elevated inflation. So what are they concerned about? So they are concerned more about the services side, the services component. So if you look at the services component over here, you go all the way down, services inflation. Okay, you open up the chart. So what we could see over here is that even the services inflation prices, after two strong months of March and April, so March it came in at 5.26%, April 5.3%, and this time in May it dipped down to 5.2%, even slightly below the March strong push up. All right, so if you look at the trend, okay, this trend here is also slightly plateauing off as well. Okay, so yes, it may remain a bit sticky over here, but given the fact that this particular situation here, I believe that because of this services inflation, that is still it hasn't clearly plateaued off yet. So this actually causes the Fed to be very cautious in their thinking when they express their view during the FOMC, after the FOMC meeting. So what do I mean by that? So the conclusion of the FOMC meeting over here is a rather slightly neutral to hawkish tone. Why? Because the Fed actually dials back the rate forecast. So like I mentioned, those who follow my daily dose of market insights yesterday, initially in March, they released their dot plot. So dot plot, right, is something like the inflation forecast of key economic data variable in US. That means the federal officials during every 3 months in their FOMC meeting, not every month FOMC meeting. So they will do it in June, July. The next one will be in March, June, September. All right, then followed by December. So it's every 3 months they will actually meet and release this dot plot. So the latest dot plot now has shown that they have decided to, instead having 3 interest rate cut in March, this time they only reduced to 1 cut. All right, so but that is rather slightly much more hawkish, because market consensus is that they want to actually only reduce down to 2 cuts. All right, and the most important thing over here is that inflation is still elevated, but noted that progress has been merely modest only. All right, the keyword was modest. Yeah, so the thinking of the Federal Reserve official, in their mindset, they are still rather data dependent. That means, i.e., they wanted to have much more data to come in to confirm their stance that inflation has indeed slowly cooled down to that targeted 2% level. So the reason why they say that progress has been made, yeah, progress made because of the deceleration that is being seen on the core CPI trend. Okay, but modest only because of the services side of it. The services component is still hasn't really decelerated as what they wanted. Okay, so this is the key takeaway of the CPI data. Then thereafter, how does it affect the FOMC meeting, and as well as the dot plot projection. So now let's go to the dot plot projection first. Okay, let me share with you. So the dot plot projection, what you guys can just go to the Fed website and obtain it. All right, so over here, right, let me share with you this what it means. This is the dot plot. So let's look at the Fed funds rate. Okay, so they will not tell you how much they will cut. They will just give you a level. Where will it be at the end of 2024, at the end of 2025, at the end of 2026? Then from there, we could do some mathematical simple calculation to deduce the implied rate cut or implied rate hike based on the thinking of the Federal Reserve officials projection. That means the projection will reflect their thinking. All right. So this was the previous March projection. So like I mentioned earlier, it was released every 3 months not every month in the FOMC meeting. So the previous one was 4.6. So if you get the current Fed fund rate of 5.25 to 5.5% minus 4.6, then thereafter you divide by 0.25. So because the Federal Reserve officials, since I think 15 years ago, yeah, they tend to actually go by the pace of 25 basis point cut. That's the normal usual situation. Unless we start to see a very drastic economic shock, like during the great financial crisis, then they will ignite 50 basis point cut per meeting. Okay, or they do it much more of a frequent basis. All right, I mean, they need not wait every month. I mean, they can come in at any point in time and step in and decide to cut whatever 25 basis point or 50 basis point. But under normal economic circumstances, where they do the dot plot projection, they imply is that every move is a 25 basis point cut or hike. Okay, so by looking at this again over here, is that if you get 5.25% minus 4.6, you divide by 0.25, that actually imply 3 cuts. Then you get 5.1% minus 5.25%, then divide by 0.25, that actually imply only 1 cut based on the latest Fed fund rates that they want it to be at 5.1%. That's the median, not the average, the median. Okay, so they don't do the average, they do the median and the central tendency. Central tendency is taking the range of the officials. So I think 14 or 11 of them. So the whole range, right, was the lowest was 4.9, the highest was 5.4. Then they take the median. Okay, so they focus on median 5.1. Okay, so this is how you read the table. All right. So where was I? Yeah, so you get 5.1 minus 5.25, then you divide by 0.25, that give you only implied 1 interest rate cut for 2024. All right, then these things will get pretty much easier, because all these are end of year expectation for 2025 and 2026. Okay, then you compare it with the previous March projection. All right, so if you get 4.6 minus 3.9, and you divided it by 0.25, in 2025, they actually implied the entire 25, they are looking at only 3 cuts. But what's interesting over here is that this particular cut here, they only have one cut, right? Initially, market expecting them to have two cut. So the one cut, that expected one cut that was not reflected in this June dot plot has been shifted to next year. Why? Because if you get 5.1% minus 4.1%, it gives you one, right? 1%. Then you get 1%. Sorry, let me share with you. Let me get a calculator so that you guys know what I mean. Okay, so very simple. You just get this, the expected end rate of 2025 minus the expected end rate of 2024, the Fed funds rate. Okay, so it's -1. Then you divide by 25 basis point each, it means 0.25. Since the movement right now, we take it as a normal circumstances, they will move by 25 basis point each, which is 0.25. Okay, 4. So what they did over here, what it means, they implied that by the end of 2025, they will have 4 rate cuts, which is 1 rate cut higher than the previous projection. Okay, and the previous, then if you look at from 25 to 26, they still maintain at 3 cuts each. So what it means that the Federal Reserve official seems to us that based on the Fed funds rates implied projection, they are much more comfortable of be more dovish in 2025. So that actually, right, causes the risk asset classes, the market didn't actually show off yesterday, despite the fact that the 2024 Fed funds expected rate implied only 1 cut, because that extra another cut that is market expecting has been shifted to 2025. So that is the plus point for risk asset yesterday. That means the risk asset going to push up, where you start to see the S&P 500 and the Nasdaq 100 hitting fresh all-time high and maintain it after the CPI release, where it rallied strongly. But very interestingly over here is that the FX market is not reflecting that. Later I'll share with you all right? Now, looking at the core PCE inflation projection as well, to see whether they are actually moving in line with the Fed funds rate, the thinking of the Federal Reserve officials. So if you look at the PCE core inflation over here, what's interesting over here is that it seems to be a bit strange in terms of their projection. In terms, if you look in line with their Fed funds rates projection, because like I mentioned over here, previously in March projection, in 2025, they only pencil in 3 cuts. Then yesterday's one, they now pencil in an additional extra cut of 4 rate cut in 2025. That means based on just looking at the Fed funds rate implied rate cut, it seems to tell us that the Federal Reserve officials are comfortable that inflation pressure will ease off in 2025. That's why they decided to push their interest rate cut by 1 yesterday versus what was projected earlier in March. Then that should also be reflected in the core PCE inflation forecast as well. That means core PCE inflation forecast for 2025 should tick down instead of ticking up. But what's interesting, it goes against this normal fundamental thinking. So you look at the core PCE inflation in 2025, the March previously they were projected at 2.2. Then now they decided to push out 1 basis point higher at 2.3. So that's a bit strange, right, over here. Okay, but what's happened in 2024 is pretty much in line with the fundamental thinking of the Fed funds rate. So they expect the core PC inflation to end 2024 at an annualized rate of 2.8. That is 2 basis point higher from 2.6. So that people understand that, stating that they are still believe that inflation is progressing towards the target of 2%, but it's only moderately progressing, not as aggressively as they want, the deceleration pace. So that's why they decide to only have 1 interest rate cut in 2024 as projected. Okay, so this is the desynchronization that I want to mention. So that actually perhaps keep market a bit puzzling of this increase of 1 basis point of 2.3 core PCE inflation forecast for 2025 versus 2.2 that was forecasted in March based on the median dot plot. All right, so the rest is pretty much unchanged in terms of growth. So growth remains the same, nothing much of a big difference. All right, so now with that, let us take a look at how the we call it the intermarket relationship, the intermarket dynamics. So let's look at the 10-year US Treasury yield. Okay, so the US 10-year Treasury yield. Okay, what's initially surprising is this was the sell-off. This is the daily chart over here. Okay, no, sorry. Give me a minute. My apologies. Let's go to the 10-year first. Yes, this is the 10-year. So the 10-year Treasury yield over here, initially the market sold off below the 4.3% level, the support level that we highlight that is still being stuck inside this range. Okay, initially there was an intraday push up. Then as when the FOMC meeting releases the dot plot and Fed Chair Powell press conference, the 10-year yield starts to push up and survive the right at the support level again at 4.3. Okay, so what's interesting over here, it means to us that the US 10-year Treasury yield kind of get the hint that, hey, the Fed itself doesn't want to be as dovish as the latest CPI data stated. That means they decided to say, hey, even though the latest CPI data, the core CPI is showing a clear trend of deceleration, but the Fed tells the market, hey, I'm still not very confident that inflation are progressing to our target. That means they decided to say that one core CPI data push down of such rate is not sufficient. Why? Because of the services component. As the services component just only show a plateauing rather than a deceleration trend. So what it means that they want to have more data out, perhaps another month or so, to flip their thinking towards to a more dovish stand. So this is what being implied by the 10-year US Treasury yield that managed to survive at the 4.3%. So i.e., what we're going to expect to see in the next coming days will be another massive sideways range of the US 10-year Treasury yield. So if the US 10-year Treasury yield starts to tick higher again, the dollar strength will start to come back again, at least on the short-term basis. And very clearly, if you look at the 2-year Treasury yield, that is much more sensitive to Federal Reserve officials' thinking and the monetary policy. Very clearly, they managed to also survive the 4.72% support level. And what's interesting is that they managed to bounce right at the 200-day moving average. Okay, so the near-term resistance will be this level here at 4.88%. So very similar to the 10-year year as well. So potentially, right, since the survivalship of that 4.72% on the 2-year Treasury yield and the 200-day moving average, very likely it will start to trade sideways again, bouncing up towards the 4.88%. So if you start to show this bounce, it could also reflect a stronger US dollar potentially in a shorter term basis at this point in time. And what's interesting over here is that later I'll touch on gold. Gold prices also trim off, I'll say 3/4 of their earlier push up that was actually ignited upon the release of the post CPI data release. But however, the gold price again, the XAU/USD, also temper off when the US Federal Reserve released their dot plot and during Powell press conference, indicating to us that the Federal Reserve officials together with Powell, they are still data dependent before they throw in the towel to say that, hey guys, we are now all out dovish. So they are much more cautious compared to their counterparts like the ECB, the Bank of Canada, and as well as potentially BOE that they decided to actually jump ahead and cut rates first respectively. All right, so with that, we could see the US dollar also managed to survive at exactly at the range support level that I highlight at 104 level, and where it bounces yesterday, it bounces off the 200-day moving average as well after that intraday sell off that breach slightly below it after the release of the US CPI. So what it means that the US dollar index now is likely to churn again in a sideways mode between 105.20 and 104 figure level. All right. So given that it may start to churn out and retest the 105.20 level, that could also implies to my earlier diagnostic that at least some kind of potential short-term dollar strength may come back into the FX market picture in general, not in general. Okay, so with that, now let us focus more on the individual FX pair. That means right now I'll touch on the intraday short-term technical outlook on the broad-based cross asset classes, starting with the major dollar FX pair first. So with that, let us start with the euro dollar. Okay, so the euro dollar yesterday, because due to kind of mixed element, we turned neutral between 1077 and 1072. Then price action break above our neutrality range and hit the resistance level, okay, as intended. And what's interesting over here is that upon hitting that resistance level at 103.35, the upper limit is 108.60 over here. The price action starts to retrace down. And where it retraces down right at the 20-day moving average. Okay, so with that, given yesterday's strong overbought level that is now has been exited, okay, potentially right now there could be at least in short term minor potential slight coming back in the euro dollar. So with that, for today, we will flip to a short-term intraday bearish bias below 1.0860 short-term pivotal resistance level. Near-term support level to watch will be at 1.077. Breakdown below it exposes 1.0745. All right, these two near-term support zone to watch. However, if we start to see an hourly close, that means a break with an hourly close above 1.0860, so potentially then we could see the extension of this rebound to expose the next near-term resistance at 1.0925 / 1.0940. All right, so that's the euro dollar. So let us now start with the sterling dollar, but before that, let me expand my screen so that you guys could see. So on the sterling dollar, yesterday we do have a short-term intraday bullish bias ever since late last week, because it managed to survive at the 1.27 figure level. So price action bounced up as intended and hit the resistance level that we mentioned yesterday at 1.2860 level, and also see a very similar steep retracement, and price action now reintegrate below the former minor swing high of 4th of June and 7th of June. So with that, and if you look at the RSI, taking into account of the higher low, okay, is now have already broken a key parallel ascending trendline support, indicating to us that there is some signs of intraday bearish momentum creeping back into the FX pair of the sterling dollar. So with that, I'll be using for sure yesterday's short resistance level. I mean, that is indeed our pivotal resistance level. Why? Because of look at how sharply it reacted from there. Once it hit V-shaped, inverted V-shaped recovery, inverted V-shaped bearish reaction, pardon me. So I'll be using 1.2860 as my short-term pivotal resistance for today, flipping to a short-term intraday bearish bias. First near-term support level to watch will be at okay, so it will be a zone, this level, 1.2760. Okay, below it exposes 1.2730, which is close to the 20-day moving average. A break below 1.2730, revisit again this range support level, minor range support level that is in place since 31st of May low at 127 figure level. Only an hourly close above this 1.2860 will invalidate today's short-term intraday bearish bias view to see the continuation of the rebound to expose the next near-term resistance at 1.29 figure level, followed by 1.2940, which is the upper limit of the minor ascending channel that I drew from the low of 22nd of April. Okay, that is the sterling dollar. Now let us flip to the Asia Pacific currency, starting with the Aussie dollar. So Aussie dollar, yesterday we were neutral as well because of a mixed element that neutral between this 66.30 and neutral between this 65.80. Then price action indeed broke up and almost rallied all the way towards our second resistance level at 67.10. So if you look at over here, what 67.10 is in fact the minor swing high of 16th of May and 17th of May, and look how the price action reacted off it yesterday. Okay, right after the release of the FOMC meeting and the FOMC dot plot, and as well Fed Chair Powell press conference. So with that, I'll be using 67.10 as my short-term pivotal support, pivotal resistance, not support. I repeat again, 67.10 short-term pivotal resistance on the Aussie dollar, flip to a short-term intraday bearish bias within its medium-term symmetrical triangle range configuration. First support level to watch will be at 66.30/66.10. Below it exposes the 50-day moving average that is coming to act as a support at the 65.80 level. Only hourly close above 67.10 will expose 67.30, which is very key. Why? Because 67.30 is the upper limit of that symmetrical triangle range configuration. So this is my medium-term key resistance level. Only kind of a daily close above 67.30, then we will start to see a much more substantial bullish breakout in first step to test the next resistance at 67.80. Okay, so what's 67.80 in short term? If you go to the, okay, let me go back over here so you can see. Okay, go all the way back. Okay, is this level here? All right, this former minor swing low turns into a pullback resistance. That's from 29th of December last year. All right, so if you could look at the bigger picture, right, on the daily time frame, this is what I mean. So now it actually reacted close to the 67.30. So what's 67.30? So this one is a medium-term resistance, which is key. Why? Because this resistance represents this descending trend line that has been capping previous rebound from not breaking out since 3rd of February. And this is the upper limit of that symmetrical triangle range configuration. So you could see that since 13th October low, it's been trapped by this descending trend line and ascending trend line, which give rise to our medium-term symmetrical triangle range configuration. All right, so that's for the Aussie dollar. Now, with the dollar yen, all right, so dollar yen right now seems to be a bit interesting. So right now, price action seems to be trading inside this kind of rangy configuration, a very kind of messy rangy configuration. Okay, if you look at the bigger picture, right, it seems to be this kind of messy complex range. Okay, so right now it attempt to go back up to the top of the minor range again at 157.50. So what I'll be using over here is that I'll be using this 157.50 as my short-term pivotal resistance for today. So we'll be flipping to a short-term bearish bias within this range over here. Because since at top of the range, the first support level to watch will be at this close to this 20-day moving average that has been whipsawing around it. So that is this also this minor swing low here. Okay, in today's Asia session. Okay, 15660. Break below it exposes the next near-term resistance at 155.80/40, which also correspond to the rising 50-day moving average as well. So only a breakout above 157.50 were able to see it hitting up to the the minor range top of 1st of May at 158 figure level. All right, so this is the key short-term intraday technical levels to watch on the dollar yen, using 157.50 as a short-term pivotal resistance. Potentially it may start to do a bit of minor mean reversion back towards the lower limit of the range again. All right. So that's for the FX market. So now let us go to the short-term technical outlook on the major stock indices, starting from the Asia Pacific indices, the Hong Kong 33 or the Hang Seng Index. So for the Hang Seng Index, still no change. Price action still managed to hold at the short-term pivotal support level that we highlighted yesterday, 7895. Bounces. Then after that, it pulled back during the Asia session right now. And now price action is trying to find some form of support by the bullish candlestick. So previously it shaped a bullish inverted hammer, and now it's forming an hourly bullish. Okay, this is an inverted hammer that right now is trying to form a bullish hammer. All right, as we are talking or speaking. So for sure, this 1780.95 seems to be us indeed a pivotal support level that managed to induce some form of bullish pressure coming into the Hong Kong 33 index. So with that 17.895 still will be our short-term pivotal support for today to maintain that short-term intraday bullish bias. Okay, so the near-term resistance to watch will be at 18,380. Only a breakout above this level exposes 18,730, which cause confluence with the 20-day moving average as well that is acting as a resistance. But however, if we start to see a sudden push down with an hourly close below 17,895, then we will start to see another round of extension of this minor corrective decline. Okay, that is in place since 17th of May to expose the next near-term support at 17,600, and a break below it exposes 17,170, which confluence with the 200-day moving average. Okay, Japan 225 or Nikkei 225. So Japan 225, Nikkei 225. Yesterday we were bullish and it actually hit the upper limit of the range at 39,290 during the US session. Then thereafter it starts to sell off again, and now hitting back towards the 20-day moving average. So it seems to me that it's now being trapped in this minor range. So with that, we'll be flipping to a neutrality stance, at least for today on the intraday basis, neutral between 39,290 and 38,780. All right. So if we start to see an hourly close below 38,780, then we will start to see another round of choppy minor corrective decline back towards this portion here at 38,550 in first step. That's the 50-day moving average also acting as support. Below it exposes the minor swing low of 38,290, which is defined by the low of 31st of May and 1st of June. So if you look at the bigger picture, right, okay, so it seems to us that the Japan 225, ever since the low of 19th of April, it tried to push up, then thereafter it tried to trade inside this kind of rangy configuration. So it's still range, okay, at this point in time, unless it's able to clear above the high of 30th of May, which is at 39,500 level. Okay, this is another 500 level, then we could start to see that it's much more a higher probability it starts to evolve into a short to medium term uptrend configuration. Okay, so with that, flipping to a neutrality stance for today between 39,290 and 38,780 on the Japan 225, i.e. the Nikkei 225. Now, with that, let us go to the German 30 or the German DAX. So German DAX 30, we have a short-term intraday bullish bias yesterday because of that rebound off from the 18,400 level, 18,350 level. It bounces and it hit the resistance level at 18,6010 and slightly below the second resistance at 18,680 level. All right. So what's interesting over here is that price action starts to shape a series of hesitation candlestick on the 20-day moving average by showing a very small little candle. So what is actually looking at the candle body over here, it seems to us that the bulls are rather hesitant right now, and where it actually pauses right at the 1868 level and the 20-day moving average. So what is 1868 level? If you could draw a descending trend line, is in fact the descending trend line that has been capping previous rally since 28th of May. Okay, so this is the all-time high. So price action is now coming close to this descending trend line again, acting as a resistance at around 18,680. So with that, right, there could be potentially another round of bearish mean reversion intraday we call it decline on the German 30. So with that, and also with the hourly RSI now exiting from the overbought level, it actually increases this chance of a intraday bearish mean reversion slide. So with that, I'll be using 18,680 as my short-term pivotal resistance for today, flipping to a short-term intraday bearish bias for that potential mean reversion slide to play out. So first support level to watch, 18,485. Below it exposes 18,400 slash 18,350. We also confluencing with the 50-day moving average, I think, as a support as well. And if you do the Fibo retracement of this last push, last rebound, okay, it's also close to the golden ratio of 61.8%. However, if we start to see an hourly close above 18,680, then that will invalidate our short-term intraday bearish bias for today to see the continuation of the bounce to expose the next resistance level at 18,845, then thereafter followed by the current all-time high area at 18,925. Okay, so that's for the German 30. Moving on, next will be the major US stock indices, starting with the US Wall Street 30, the Dow Jones Industrial Average. So the Dow Jones Industrial Average also rallied as expected and hit our resistance level, the second resistance level at 39,130. So what you are seeing right now over here is that potentially it could be back inside. It's trading at the upper limit of a complex range configuration. And where it reacted pretty strongly on the negative side after hitting the resistance at 39,130 and also banging off the 20-day moving average by shaping this very strong inverted V. So indeed, right, this level here is indeed like a maniac hit, and thereafter it react bearish negatively from it. So with that, I'll be using 39,130 as my short-term pivotal resistance, flipping to a short-term bearish bias on the US Wall Street 30 for that potential mean reversion slide within this kind of rangy configuration again in the short term. First support level to watch will be at 38,530. So that was the pivotal support yesterday that lead to this bounce. A break below 38,530 exposes the next support area or support level at 38,280. So that is the minor swing low of 4th of June and very closely the level. Okay, only an hourly close above 39,130 will kind of invalidate the short-term intraday bearish bias to allow it to exit out from its range and have a higher odds of kickstarting a short-term uptrend phase again. So the next resistance to watch after 39,130 will be at 39,390, followed by 39,730. Okay, now moving on will be the Nasdaq 100. So Nasdaq 100 going to outperform yesterday. So net overall, it really hit the resistance level at 19,570 that we highlighted. So we highlighted 3 resistance levels there. So this is the third one, it already hit it. So what you could see over here is that the Nasdaq 100 now is trading with a very highly overbought level on the hourly RSI. So and also potentially now is banging off from the upper limit of this medium-term ascending channel that I drew from 19th of April. And if you look at from a short-term perspective, linking up the higher lows from the rebound that took shape off on the start of this month, taking up the lows and I push up to the high. Okay, you also hit the upper limit of this short-term ascending channel. And if I do a Fibo extension, taking into account of this minor push up here as a wave 5, 1, 2, 3, 3, then 4, then this could be the wave 5. So if I project it from here, okay, you see a one-time 5th wave extension terminal level at 19,080, and right now it's very close. If we hit the 19,000.67, the 0.76, no, where is it? The 0.765, okay, is somewhere around this level. Is playing around it. So with that, right, there could be given that there is 1, 2, 3, 4, 5 wave up, and this 5 wave up ended at the upper boundary of both the medium-term ascending channel and the short-term ascending channel. I'll be using this 19,800 level here as my short-term pivotal resistance for today, on the Nasdaq 100. So I'll be flipping to a short-term intraday bearish bias. So this is intraday bearish buy view for a potential short-term mean reversion decline scenario. Support level to watch will be at this 19,240, followed by 19,100 level, which is close to the lower limit as well of the minor ascending channel that I drew. And if you do the Fibo retracement of this entire push up from the start of this month all the way up to the current minor swing high, it's close to the 38% Fibo retracement. So after 9,100, we'll expose the 18,910 level. So this is important why price action, once it come down and test this level, it got to shape some bullish reversal candlestick, because this is correspond to the rising 20-day moving average. All right, so that is the view, the key levels to watch on the Nasdaq 100. But for sure, if we start to break out above the 19,800 level, I got to respect this very strong, steep, impulsive move. Then that will actually invalidate today's short-term intraday bearish bias view for that potential mean reversion slide to occur, to see the continuation of the impulsive phase or impulsive sequence, to expose the next near-term resistance at 19,990, followed by 20,120 / 20,155 as defined by various cluster of Fibo extension levels. All right, so that pretty much sum up for the short-term technical outlook on the major stock indices. So what the major stock indices over here is that we start to see some form of potential short-term mean reversion intraday slide on the Nasdaq 100, on the Dow Jones Industrial Average, the US Wall Street 30, as well as the German 30. Mixed bag for the Nikkei 225, and for the Hong Kong 33, since it's still surviving a key short-term pivotal support, we will still maintain a short-term intraday bullish bias on the Hong Kong 33. Okay, so with that, let us now move to the commodities market, starting with the gold. All right, spot gold. So gold XAU/USD. So what's interesting for gold over here is that it managed to reintegrate back below the 2,320 level. So if you look at over here, is that initially it pushed up, break above 2,320, hesitant above, slightly below the 50-day moving average. Then thereafter, it did that bearish reaction plunge and break and reintegrate back below 2,320. So this is what gold price is reacting right now. So gold price is actually also reacting, in at least in the short term, to what the US 10-year Treasury yield is stating. So given the fact that gold price, right, gold itself doesn't has a recurring fixed income if we decide to hold gold, because it's a non-interest bearing asset. So given that the US 10-year Treasury yield is being kept by the support level at the lower limit of the support zone that highlighted yesterday, so that could actually cap gold strength as well. So that's why you see that bearish reaction off at the 50-day moving average. So in terms of the Fibo level, if you do the Fibo retracement, okay, it's also close to the 50% Fibo retracement as well. So with that, I'll be using that 2,388 level as my short-term pivotal resistance for today to maintain that short-term bearish bias on gold. First support level to watch will be that bounce off from Tuesday at 2,300, a break below 2,300 exposes the 2,280 / 2,270 near-term support zone, pardon me. Only hourly close above 2,338 will negate this short-term intraday bearish bias to potentially see another round of rebound to kind of retest the 20-day moving average that's acting as a resistance at 2,354. A breakout above it, then we will start to question that gold itself may start to see a renewed short-term uptrend again, since it managed to clear above the 50 and 20-day moving average. Next resistance and first step to watch will be that sell-off swing high on last Friday at 2,386. Now back to West Texas crude oil. So West Texas crude oil on the intraday basis, it did a wild move by looking at the daily chart. So on the daily chart over here, if you could see, there's this little spike up over here, spike up, but this spike up can't maintain their bullish momentum, and it ended the day with a bearish shooting star formation right exactly at the upper limit of the resistance zone and bottom limit of 76.60 and 78.40 level. All right, this line here. Okay, let me remove this so that you guys could see this line. So what you could see over here is that given the bearish reversal daily candlestick, what is on the daily chart, there is still some form of hesitant of the rebound to potentially continue. So with that, right, we will still have a short-term intraday bearish bias on West Texas oil. So I have a bit of excess of yesterday pivotal resistance 78.90/79.45 using yesterday minor swing high. First support level to watch for sure will be at 77.60. That can't break out. That was the swing low of Tuesday. Only a breakdown below 77.60 will start to see a much more pronounced slide to expose the next near-term support level at 76.70/76.30. However, if we start to see a push up again at 79.45, then we got to kind of respect the ongoing rebound to invalidate today's short-term intraday bearish bias to see a push up with the next resistance coming in at 81 figure level. So that is the minor swing high of 29th of May, and above it exposes 81.90. All right, so with that, let's sum up the short-term technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the calendar of other key data to take note of for today after yesterday key risk event. So today key data over here during the European session, we do have the industrial production for April that is released at 5 p.m. Singapore time, and we do have factory gate prices for US, the PPI. Not that important because CPI is much more important given the fact that the US economy is more driven by the services side of the story, but markets still do pay attention to it. So at 8:30 p.m. Singapore time, we'll see the release of the PPI, US PPI data. Then thereafter, it will be a rather quiet session. But do take note that no time has been indicated yet for today. There will be a release of the new yuan loans from China and M2 money supply. So this is very important to see whether there will be a take up in financing or not. Okay, despite the fact that there is ongoing piecemeal stimulus measures that has been enacted by China top policy makers. Then thereafter, now we kickstart Federal Reserve officials speaking, because now the Fed officials can speak because the last FOMC meeting is over. So Williams will kickstart his speech first. So market will pay close attention to his speeches, especially yesterday's slightly neutral to hawkish US Federal Reserve dot plot ratio, dot plot chart or dot plot projection. So he'll be speaking at 12 a.m. Singapore time tomorrow, early tomorrow morning. So with that, before that on Friday, we also do have the start of our Asia session. We have Australia consumer inflation expectation up at 9 a.m. and most important will be BOJ interest rate decision at 11 a.m. Singapore time. So we will talk more about that during at the start of our daily dose for tomorrow. All right, so with that, do have a great day ahead and we shall speak again tomorrow. This is Kelvin here signing off. Thank you.